welcome to episode 31, Accountability at its finest.
We've managed to stick to for 1 week in a row for our streak of 1 week. We're back.
We are one from one. That is the key thing, Arnie. It only goes up from here.
Yeah, so just introductions. I'm Arnie, tax professional.
Joel Seach, principal advisor.
Brad Tabone, generalist.
No, Brad Tabone, global travel blogger and
global travel blogger. My Carmen San Diego hat is not here yet. It is en route from America, since that's the only place that I could find it. But it will be making
a listeners don't know who we're referring to, because maybe we're kind of that generation that I don't know if they still have it in the computers at school. I remember playing the game and learning about it. But Carmen San Diego, Google it.
I don't reckon they'd know it. Yeah, I think we're showing our age a bit.
Oh no!
Oh no!
Great to catch up with the crew. Good to be here. Different setting for me today in the office, but I did bring my proper microphone, so hopefully all loud and clear.
Very professional there, Joel.
Trying to.
It is a good looking office, mate. I like that globe in the background. That's
like globe. Make it look the part.
It's like Scarface globe, eh?
A little bit of greenery up the top there, if you can see.
I can see. Yeah. Is that real or is that fake?
I paid someone to do it, so yeah.
Is it a real plan?
No, I don't think so. I haven't ordered it, so I'm presuming it's not. So yeah, it's good to catch up with everyone. Plenty of topics to chat today in a short, sharp podcast and recording, and we've got a good Q&A coming up as well from one of our listeners, which came in this week, which is terrific. So we've actually done some research, and it's amazing what accountability will achieve when you know that you're recording weekly. So thanks for tuning in last week. Hope you didn't miss us too much, and we've got some good topics to cover off on today. So what do we want to start with today, gents?
Riskin's rules. No, Riskin's rules, but we're freewheeling a little bit.
I feel bad because I've left the book at home, but essentially it'll just be one from Google today. So here's a nice, easy one. When buying shares, ask yourself, would you buy the whole company? So that's one straight off Google, nice and easy, and still a relevant point today.
We can clearly see that Rivkin was a student of Ben Graham, Warren Buffett, because that's value investing 101, isn't it? Like, think about it like you're buying the whole company.
Absolutely. So, covering off today, gents, which topic would we like to start on?
Yeah, so
Twitter.
Yeah, so we thought just tankers, we're going to run through Twitter, we're going to run through growth stocks, and we're going to run through some construction issues in Australia. But we'll start with Twitter, and I pulled up a bit of a timeline here just so we can do a refresher about how this has happened. And there's a few key dot points here, so I'll try and run through them quickly, and then we can discuss any of the major points we want to talk about, boys. So this all started January 31. Musk started building up his stake in Twitter. And
silently.
Silently. And then around March 14, it was disclosed that he had a 5% roughly stake in Twitter. But he didn't want to disclose that, so it dropped back down under 5. And then there was the March 24 when Musk started saying, should Twitter change? And I think he put a poll up about free speech. March 26th, Elon reaches out to Jack Dorsey to discuss the future of social media. Pardon me. April 3rd, Twitter leadership meets to discuss Elon Musk. April 4th, he becomes the largest shareholder with a greater than 9% stake in the company. April 5, Musk agrees to join the board. April 10, he ditches the board. April 14, Musk offers to buy Twitter and unlock its potential, making an offer of, I think it was $54.20 a share. April 15, the board adopts a poison pill provision to have the ability to fight off Musk in the event that they do not want to accept his offer. April 21, Musk lines up $46.5 billion in financing, which includes using some of his Tesla shares as collateral, which is a key point we can discuss after. April 25th, Twitter agrees to sell itself to Elon Musk at $54.20 a share, basically valuing the company at around $44 billion. April 29, Musk cashes out billions in Tesla stock, to fund a portion. May 4th, with a little help from his billionaire friends, he looks to, put together the financing. May 6th, he says he's got lofty goals for Tesla, and he wants to increase their revenue he wants to increase it to $26.4 billion by 2028. That's what he said, which would be up $5 billion from last year. May 10, Musk says he would reinstate Trump's account. And I might add as a little aside here, Trump has come out and said he won't come back. May 12.
Has started his own.
Yeah, well, why would he come back to a competitor? And then May 12, there's a partial hiring freeze and executive departures in Twitter. And then May 13, the Twitter deal is temporarily on hold. May 14, there's potential NDA problems. May 16, Elon tweets the poop emoji in response to the CEO's tweet thread. And then May 17, Musk has said the deal can't move forward because he wants to see open source analysis because he thinks Twitter's being misleading about how many bot or fake spam accounts there are. He thinks it's in excess of 20%, and Twitter's SEC filings are saying it's less than 5%.
Well, they do say 5% with an asterisk, and that they use in-house,
they do spot
algorithms and ways of. And
we can talk about that, but just to cover off on that, because that's just we can work backwards if you want. Twitter has said that they use a random sample, which is the approved method by whoever enforces that in America. I assume it's the SEC. And then apparently the way they do it, I looked into this unrelated to Money in the Tank. I looked into this the other day just because I was curious, and they were saying that it's a sampling of 100 accounts, but I know my first initial impression was that's really, really small. But it's then not clear how often they do that, and it's not clear if it's done manually or if it's done with.
Well, they use a lot of manual. So just to add in a bit there, Elon said that he'll be grabbing 100 accounts as well, as per the method, and they told him he couldn't do that because he doesn't have access to the back end to look at log files manually to ascertain. So it might look like it's a bot, but it isn't a bot, and there's very good reasons why that account. So.
Yeah, well, the thing that springs to my mind, and someone who was sort of, because I was criticizing this, and someone said as a counterpoint, Arnie, you don't know how many times they do it. It could literally be a sampling of 100 accounts done 500 times a day, a week, a month, whatever. So it could be millions and millions and millions of tests to check this, and also it would be a rolling average depending on users coming and going. So I feel like
again, that question can't be answered, but I doubt it's hundreds of times a day if it's done manually.
No, I agree. I really doubt it would be. I feel like that would just be over and above. So I feel like
they've done it once in the last 4 years.
It's too opaque, basically. That process is too opaque. So I feel like Elon might have a point there, but will it be enough to get him out of his deal? I don't know. So
they're looking to enforce. I think as of yesterday, the board said they're looking to enforce the
deal.
The deal.
Yeah, which means
the provision in there, I think.
Out of it, or is he posturing to get a discount?
I think he's posturing to get a discount personally.
It could be either, right?
I think everyone knows that there's a lot of bots in that. The SEC filings have said 5% or more, and it's been quite opaque for a while. And I think the other bit is that the deal contract itself states that there's a clause that he can get out depending on due diligence. But the amount that it would have to affect the price of the share and earnings is up to, I think, 20 or 30%. And I think that's where, Arnie, maybe you've heard the 20%, because he might be claiming it's 20 or 30%. That basically he can't get out of the deal unless he finds something that impacts earnings by 20 or 30%. And so even if bots were 5, 10, 15, even 20%, I don't think he's actually quite high enough to get him out.
Well, 20%, he would then have to extrapolate on like that 20%. How does that impact advertisers' revenue? And then he'd have to make some sort of assumption there. So,
there's always wheels and means, right?
Yeah.
But it's interesting. Is it that also going back to one of your points before around him using Tesla as a form of backing for debt? Tesla stock over the last month, Arnie, what are we looking at?
Oh, a huge drop, man. I think, let me just quickly bring it up. But
I'm going to say 20%.
Yeah, it probably has, because obviously there was the forced selling.
Look.
It's down 30.96% over the last month. So it went from just over $1,000 down to 709 as of the last trading.
So when you're taking out debt against shares, which is something that I'm currently looking at, they obviously grab your shares and look at the risk factor around that and provide you a proportion of the share's value. I can guarantee a 30% hit would be affecting funding, especially with kind of interest rates the way they are, and growth stocks the way they are. So, I mean, that's also could be part of the parcel. I don't think it's subject to finance because he came out saying it's secured finance. So, you know, there could be a bit of part A, which is, you know, he wasn't expecting 20%, 30% spam, you know, bots. Could be a bit of part B, Jolie, which is around negotiations and trying to get the lower price, or a bit of part C, which is he's actually needs to get a lower price because I'll be back to Tesla. That's kind of my 3 points.
Yeah. So just on that, Jolie, is he looking for a way to walk away? Is he looking for a discount? I think he'd happily accept a discount. I think ultimately, though, he's trying to retroactively walk back what he said and look for a way out. I do think he's looking for a way out. And I reckon there's been a lot of talk actually in the media because, you know, all of these documents were made public about how it's not as simple as Elon paying the breakup fee, and the breakup fee in the contract was $1 billion.
$1 billion.
So I feel like at this point he'd be happy to do that if he could just quickly, you know, pay $1 billion and walk away.
So disgusting if you actually think.
I know, but
just a quick bill.
But then the issue is that because he's got these parts of the contract which are split up in how they've thought about the financing. If he does do that and pays the $1 billion fee, lawyers in particular, all over Twitter and other social medias are postulating that he could then be sued by Twitter shareholders for up to $14 billion, which is the part that he was going to use his Tesla shares as collateral for, meaning they would just come after his wealth anyway until he could pay that amount down. So
all very interesting.
Yeah, and I don't know if you guys have been following, you know, parallel news to this, but SpaceX was selling some of their shares on the secondary, or whatever market it's called. Secondary, yeah, and not issuing new shares. So potentially Elon was selling some of those at, I think it was like $70 a share or something like that. So maybe he's raising a bit of a war chest just to either fight this off or go to court or to acquire it. I don't know.
How funny would it be if the whole thing stemmed from him, you know, kind of with his using his social media platform to sort of say, hey, you know, buy Twitter's free speech, and never thinking it's going to eventuate. And then they've sort of called him on it and said, oh, yeah, okay, well, yeah, come buy us and we've approved it. And he's like, okay.
Damn it.
Uh-oh.
It's just interesting, like, because part of me thought, like, this is just Elon being Elon, and like you said, Joel, just getting himself probably like tangled up. But if you look at how specific he was in kind of him grabbing that first 14 a bit percent, and him on purposely taking SEC for, hasn't been fined yet, will be fined for not lodging kind of that he's got certain stakes because he knew the price would go up and it would cost him more, and it would be cost him less to actually just do it on the sly and get a fine.
And he wasn't supposed to publicly comment on the deal, yet he's put the thing on Twitter. And
correct. I mean, it's just who he is, right? I think, you know, he had some intent, he saw some value, he thought he could do some stuff, and it's turning out to be harder than he thought. And at the same time, I mean, when you're juggling Tesla, SpaceX, Neuralink, you know, this goes on.
Boring company.
I think,
you know, do you know what I think is going to happen? Like, because based on this selling, they're estimating that he has raised about $8.5-9 billion of capital from selling Tesla. So he's taken a fair chunk of Tesla off the table. We don't know how much he potentially has earned from this secondary with SpaceX. So let's say he's sold another $7 billion worth. He might be looking at just changing that clause about using collateral and just putting that part up himself. I don't know how he's going to do that, if that'll work or not. But so essentially, he might be trying to change the contract to private investors, and I think he's got another 7 or 8 billion from private investors. He'll cover that 14 instead of using shares as collateral now, and the rest will be financed against Twitter.
SpaceX secondary is valued at about 60. So
yeah. What his total holding?
He owns about 40%, 47% of SpaceX, and it's valued at about 130 billion. So,
okay. So we'll continue to update the tankers on the progression of this one, because I'm sure it's the last we'll hear of it.
Well, me as a Tesla shareholder, I'm paying very close attention to this because it's a bit of a sideshow, you know.
Yeah,
it is indeed.
Absolutely. And Arnold, favourite bloke in the world, Elon's just, you had the first.
And Twitter.
Mate, so
I mean, this is Arnie all over it, really, at the moment.
Arnold.
Tesla, Twitter, Elon.
Two of my favourite companies, boys. Yeah.
Indeed. I mean, I think it flows on nicely, though, when we talk about kind of reduction in Tesla shares. To probably have a bit of a chat about growth stocks.
Yeah. So we'll chat about growth stocks. And Brad, I know you were going to share your screen, so we might give you the host duties now.
Host duties.
You've got the control, mate, and I'll put
time for everything.
I'll put you on speaker view so you can share your screen and the
listeners on speaker view, mate. That's just crazy. I just thought we'll go over growth stocks for the tankers because I think it's coming up in the news more and more, and we've used the term growth stock. And I just saw in the news yesterday, doom and gloom is. It's funny how the media just jump on either one side or the other, and it's just suddenly goes from like, we're in the best place ever to doom and gloom. But talking about Atlassian, how it's dropped, I don't know, 50, 60%, and it's, they're saying it's going to drop another 80, 90% because it's a growth stock. And I just think like it would be good to kind of run through growth stocks, a bit about why they had their time in the sun, and then a bit about kind of what's causing or what has caused the drop in growth stocks. I think we talked about it last episode. Netflix is like 70% dropped, Amazon's, everything kind of dropped around that part. And then kind of what a bit of the future looks like. So spend about 5 minutes or so having a chat, and then Jolly can chime in with any additional facts that I've missed. And Arnie.
And always don't remember, folks, general in nature, so do your own research and advice.
Of course. We are just three guys getting together having a chat.
Absolutely. So are you going to share screen now, Brad?
I'll talk for a bit and then throw up the screen, Joel.
Sounds good.
So growth stocks, I guess, for people to understand, these are things that, especially over the during the pandemic, got their time in the sun, but they really have had their time in the sun for a good, I would say, about 10 years.
Biggest bull run ever, based on
biggest
growth
bull
stocks.
run ever. And so we'll leave interest rates to the end.
Yeah.
So I'll kind of leave it out and just kind of talk to growth stocks. So they're companies with high revenue growth, whose kind of investment thesis is, your investment thesis is based on kind of one simple kind of assumption, which is if the company can continue to grow its business at a high rate for a while, let's just say 5-10 years, then it's definitely worth paying more for today than if it had like zero or low growth, right? And so, the difference in price to a non-growth stock is known as the valuation premium. And this is all about kind of, P&E metrics and the rest of it. And so there's usually a very big difference in the price. And part of this is because of, I guess, the actual calculations, which we'll get to in a second. But part of it is also due to, I guess, this bull market and this, a lot of commentary around growth stocks and stuff. So, for instance, Tesla hit a price earnings ratio of 135 because people kept thinking that it's going to continue growing at like 30% a year for decades. Therefore, they're willing to receive a 0.7% earnings yield today, which is very, very low, because they're going to get that high yield down the track. And so I will, Jolie, share the old share the screen. Can you see that?
Yeah, we can see that. Zoom in a little bit because it's kind of
zoomed a bit too far. Give me 1 second, boys. Just first time at everything. I'm going to go here. It's a little bit, might be a little bit.
Just drag your bar across at the bottom.
Yeah, it's not dragging very well, Arnie. Down here, but anyway, we'll stick there.
That's right.
Tankers, feel free to zoom in if you want to. So I'm just going to go to scenario 1 here. Obviously, stock price is going to increase and decrease, but this is ease of chatting today. Let's just assume flat. And so if we're looking at something like around earnings growth, and it's going to grow for a while at 40, 30, 20, 15 over a period of time, you can see that kind of PE ratio kind of get lower and lower and lower and lower over time. So it starts at 48 today. But if we keep growing and growing at 40 and 40 and 30 and 20, etc., and the earnings per share keep increasing, then kind of your PE ratio, eventually gets that 10% number. So today you're taking 2% and then it kind of increases. So buying into the growth stock for future growth makes sense, right? When that occurs. The problem is that we have been in the longest bull market for so long. And so therefore, especially over the last 3-4 years, similar to kind of, me personally opinion, similar to housing prices, people kind of gone, stuff can't go down. This is just like everything's a constant, variables are constant, growth's are constant. And then you have a look at something like Netflix. And this is only as April 25. It's actually even worse now. But Netflix, as you would have seen, has taken a tumble since, really at the end of last year and January this year and starting to come in. It's taken a tumble along with Palantir and all the other ones that we talked about. And if we go to...
Brad, did you want to copy and paste this in the chat box? I might be able to snip tool it, bring it up a bit larger.
Sure. Can you copy and paste pictures, can you?
Yeah.
Or email it to me.
All right. Give me 1 second.
If we
chatting while you're doing that, Brad, and just so the listeners or the people watching on YouTube can see it, growth stocks historically, as Brad suggested, you're buying them on future earnings potential. So they're not renowned to pay a lot of dividends. So
they still pay none because they're actually not making a profit.
Yeah, they're not making a profit, and they're reinvesting and essentially trying to grow and magnify those growth stock outcomes. So that's essentially what they try to do.
I might just add in there that when Brad's talking about this, and just as a bit of a fundamental background for the tankers, if you're thinking about a company, they've typically got a life cycle, and the growth companies.
I'm about to get into that, but go on. No, go into it, mate.
I was going to say that they've typically got a life cycle, and the growth companies are normally at the start of the bell curve. Apologies, I'm losing my voice. And so with those growth companies, typically why they don't pay a dividend is they try and take every dollar they earn and reinvest that capital to spin up more growth and try and get that compounded annual growth rate that Brad's talking about. Because if they can keep hitting those high growth rates, they want to try and take as much market share as they can from their competitors and probably strangle the competition and earn a monopoly, so that when they do get to profitability and can flip, they can then start to benefit from the economies of scale and also the monopoly that they've created, so that when they're in maturity, they start returning cash flow to their investors. That's the theory behind why they do that.
And I think that's part of the problem that we've got is that people have forgotten that, that business cycle for some of these companies has been going for 10, 12 years. And the business, where it is in that business cycle matters, Arnie, because no company can stay at growth levels of, let's just say 30 to 100% growth forever. It's just, there isn't a company in history.
Except Tesla.
General advice. So, Joel, I've thrown that over to you, Joel. I don't know if you can throw that. Send it to you on Messenger. Don't know if you can throw it.
I'll get it up and snip tool it, mate. So bear with me a second.
Okay, everybody.
Carry on there, Brad.
But I'll carry on without the lovely thing. The problem there arises a few things. So this is really, really good as a part of any kind of business cycle. So with that said, I guess, you might be asking yourself why are growth stocks crashing today instead of last year? There's kind of two answers. The first one is there's probably a bit too much optimism. So, whether it's Wall Street bets or it's a few other things out there, everyone just bit of having a bit more extra cash on the side and a bit more too much time to play. Everyone was just kind of jumping into these things and kind of thinking to the moon. And I think the second one, I guess, reason for it and something that I kind of left out is interest rates. And I guess when I was describing growth stocks, I deliberately forgot to mention kind of interest rates. And that's not that they don't matter, because they really do to growth stocks, but rather because they've been locked at near zero for the past few years, right, for a while. And that plays directly into the calculation. So if we think about with raising interest rates, the cost of kind of delaying at the time in which investors realize these profits, if you take, I guess, profits 10 years down the line and money costs zero, then great. But when the cost of money goes up to 2, 3, 4, 5%, we'll just call it 35 basis points at the moment in Australia. But if the cost of money goes up, then the value of those deferred cash flows also goes down, therefore making the stock worth less today. So practically speaking, a good example I kind of came across was over the past month, the cost of equity has gone up almost about 3% on the private markets and the rest of it. On a stock like Microsoft, this alone changes the value swings by almost 15%, right? And so if that's a profitable business, you can kind of guess what that does to an unprofitable business. And so it's, again, we're looking at scenario 2. It's, sorry about the, we'll work on our screenshots. But the same kind of example, looking at kind of, what happens if the price goes down and earnings growth starts going down. I guess you're no longer going to kind of justify the valuation anymore, because you haven't got those kind of, you're not earning, you're not making that growth on your investment anymore. And so years down the track, we're not picking up the value anymore, where we're supposed to be picking up, and where we're, like Arnie said, on the business curve. And so that's, I guess, why multiples, for instance, in an area that I'm specialist in, which is kind of construction technology, you've seen kind of companies like Procore and stuff go out to, I think about 20, 25 times, and they've come back down to about 9 times, and they're, $8, $10 billion company. And you've seen this across the NASDAQ, across all kind of tech growth stocks. They've all taken a hit of anywhere between, I think, we talked last week about Apple even taking, I think it was about 15, but I mean, they're a bit different because they're hardware and they're not just your pure growth, but they've taken a hit of between 15 and 70%. And it's something that, as interest rates keep, it's just something to be aware of to the tankers, that as interest rates go up, growth stocks get hit more and more, because future growth is going to be impeded by interest rates and the cost of actual money. So I just thought I'd just throw that out there. It's a kind of a Brad generalist just explanation. There's probably some stuff, Arnie, from your side, and stuff, Jolie, from your side, being professionals in the field.
No, you probably understand this better than I do, Brad, because you've worked professionally in these services before. You've also
take me a screenshot of Jolie. But
yeah, you've worked professionally in this space before, and also you've obviously had very close association and experience with it when you started your own company. But I think it's just to summarize for the tankers, what you're talking about here is interest rates all-time lows for the last 10, 15, 20 years since just after the GFC, right? And what that basically means is cheap financing for companies. So even if they are not growing profits and cash flow, but still growing top-line revenues, they could always fund their business with cheap debt. And as long as they're showing that constant growth, people are happy to invest, because they're saying that we're going to kick that cash flow down the road, and when it comes, it's going to come in big, right? So they keep promising it, and as long as they can show
to take
growth,
more and more money, basically, suck up as much money as you can from debt markets, equity markets, from wherever. Yep.
That's right. And a good example of this, and general in nature, a good example of a company that has adopted this business model is Uber, right? Uber has been unprofitable for such a long time, but I think they maybe now are starting to flip to profitability, because they are just crushing their competitors in every market, and they've just been able to take advantage of these economic conditions across the world where they can just get cheap debt financing.
Well, they're trying to scale up while the money, they came in earlier when the money wasn't as cheap, but they've focused on, just piggybacking on you there, Arnie, Uber's focused on scaling first and getting themselves out there before profitability, so that inevitably they've got the footprint there, and then when they flip to profitability, then they're already established in all the multiple countries. So they focused on that, as opposed to making profit early.
And 2 interesting examples that we can talk about. And Brad just had the Netflix sticker up there when he was showing us scenario 1, scenario 2. So Netflix, right? Netflix is a very interesting case, because they've said in the last earnings call that they've lost 200,000 users, and they're forecasting for the next quarter they're going to lose 2 million users. And they've cited the Ukraine-Russia conflict as a big chunk of that, like they've pulled out of that region. However, investors are not giving them credit for that, and all they're hearing is you're losing revenue, you're losing growth in users, meaning that you're already not. I think they pulled a lot of their growth forward in the pandemic, because people who would normally not sign up for it signed up for it. But after that fact, now they're saying, well, you're still not really profitable. But Netflix is an interesting case because they're one of those companies that takes every dollar they earn. And even before they were the pandemic, they were taking all the debt they could take on board to finance new content to create their own IP, with the view that hopefully in the future, that IP will be recurring revenue, which has been fully depreciated and will just keep being a constant stream of income for them. So it's an interesting case. But if you compare that with something like Facebook, who also reported a slight slowing in user growth across their family of apps, they also got hit really hard. But Facebook, if you think about like throwing all the way back to the start of that conversation with Brad and where they are as a company in maturity terms, Facebook is a very mature company. Facebook is a cash machine. They've already, I think they have like something like, it's like one third of people in the world use daily a Facebook app. So
Yes.
it's, you know what I mean? So it's like,
It's 2 billion. It's like 2 billion active users.
That's right. So it's like almost a third, or say a quarter of the people in the world use one of their apps once a day at least. So if you think about that, they don't have much room to grow. So it's almost in a way unfair that they're being treated the same way that Netflix is when they're like still relying on growth. Netflix doesn't need to grow anymore. They're making money. There also was that whole kerfuffle about Reality Labs and how they're taking losses there because they're investing heavily in the future. But
I think you'll see two things, Arnie. Really quick, wrap this on. But I think you'll see two things. You'll see companies like, say, Facebook, like Meta, Meta and like Google and Microsoft that are pumping out cash, right? They're cash machines. They've taken a hit. Will be interesting to see kind of what further hits they take. Then there's companies like, Netflix, which are taking on $16 billion of debt, that have two things. They've got reducing numbers because of the pandemic, but they've also got, increased cost of debt probably in future to actually continue to finance that debt. And they're not going to be taking on more.
Increased competition.
Increased competition because of where they are in their business cycle and the rest of it.
All these streaming providers.
Again, where they're in their business cycle, right? They're on number one, nothing like it. And now there's 52 streaming apps.
52?
52. Yeah, I read that the other day. It's actually crazy. I mean, there's 7 that make up like 90%, but then Australia's got like Binge and all these ones that,
Wait, just quickly, boys, tell me which ones you guys have. Which ones do you pay for?
In America, I had HBO Max, Disney Plus, Netflix, Hulu. Over here, Binge, I think it is.
And include Spotify.
Spotify, Binge, Netflix, that's basically all. And
Jolie,
Disney Plus.
What do you have, Jolie?
Oh, you got to share with friends, don't you? So,
no, which ones do you pay for?
What do we pay for? What do we share? I think we pay for Netflix, Disney, and Spotify, I reckon.
I'm the same as you. I pay for those 3.
But I must admit, Netflix I've sort of haven't really kind of gone to lately. And I've got a Plex account as well, which is good. So shout out to my mate that helps me out with uploading stuff to Plex. But yeah, I do find that a lot of the stuff on Netflix I flick through now, and the kids don't really kind of.
And the price has increased. I mean, I'm paying like $15 US on some of my apps. So.
Yeah, it's like, and I think I don't know if I've mentioned in pods before, but Netflix, many years ago, they kind of shifted their mindset of just being kind of this streaming provider that brings all these things in, and they saw this competition coming in with your Disneys and your Warner Brothers and all those places that. They saw, well, these guys have got historical content that they can kind of compete with us on. How's the shift of direction we're going to need to be now? Netflix talking about to kind of take them into the 21st century. And that's essentially where the IP stuff came in.
Tiger King, these sort of things.
Content. And they actually flipped CEOs, I believe, at the time from someone that was kind of around the streaming side of things to someone that could take the direction of content being the big thing. Because they saw that as the differentiator. And, it's maybe still up for debate whether their content they've created has been more quantity over quality. There's probably some good hits and good winners in there. And, you have your swings and you have your misses. But, that's probably, if they're pegging it on that, they want to try to get, hits on it. And I guess maybe as the jury's still out on how successful that's going to be for them. And because when you're dealing with your competitors, they've had decades of swings and misses, and they've kind of established what works and, what's a series that's going to hit. Netflix are probably still in the infant stage of working on that and trying to work out what works, what doesn't.
Well, they're a new content company, right? At the end of the day.
I don't know, like, if you wanted to, if you talk about just on like an awards level, they're doing really well from a TV show and a movie perspective for originals, making it to those award shows in like, like Hollywood. So interesting space to watch. But I guess like just a cap, it's a good example for the tankers about what a growth stock is, why they're suffering at the moment, because, they're not getting access to cheap capital if they require it. And they're also probably losing growth because with tough times coming, consumers are going to cut spending in these areas. But I guess just something to keep an eye on, that when conditions reverse, you might find a bargain here, tankers. So general in nature. But
I was about to say, generally when things general advice in nature, but there is generally, when these things happen, like Arnie was talking about before around cash cows, right? Everything gets just like wiped at once. And, when everything just gets wiped at once, without kind of thought around things, just because that is the lay of the land, you can generally, that's when value is.
General in nature, but I am paying very close attention to Facebook at the moment. And it's in a very attractive spot. Just simply.
I'd also like to see snippets of when Warren Buffett's buying, and he's been buying recently.
He's been a big growth stock, especially for the last 3-4 years while he was sitting on so much cash.
He bought Citibank recently.
But let's just talk about 2018, 2019 to basically this year. Basically did nothing, and he was getting a lot of. I'm trying to work a PC word. I was going to say a lot of crap for sitting on the sidelines, but he was just saying it just doesn't make sense, right? And again, getting proven a bit right around that. And you've seen obviously a huge pullback in a lot of these.
So if an investor in the world has started seeing some value out there and started buying, then it's sort of testament to what you're saying, is when people are fearful, he doesn't care about that.
Well, that's when he buys. He always says, buy when people are fearful and sell when people are happy. So I know he says it, as I was just paraphrasing. We're about, about 45 minutes in, boys. Should we, we're going to talk about construction, but let's leave that to next week since we're doing this weekly now.
Yeah, we've got a good question to talk about as well. Yeah.
And we've got a good question. So I thought we're going to talk about construction and Metricon, but another week we'll let a lot more information come out about this. At the moment, sure. I reckon the next couple of days will be big. So next week's headliner will be construction and Metricon, unless something else happens in the markets. Yeah. And we'll do a bit of a Twitter update.
Just like a little spoiler, it always does.
That's why I said if. And chances are.
So that'll be a great topic for next week. So tune into that one. It'll be really interesting to see how that all unfolds. But great Q&A this week from Emily, who's a listener of the pod. So she's written in, "Hey guys, do you have any knowledge on the Spriggy pocket money card/app for kids, or any other option along these lines? Just looking into options for my 8-year-old, or am I better just keeping with your standard bank account scenario?" We threw that out to the group, and we've actually done a little bit of research on it to understand what Spriggy is and how it works. And general in nature, we don't sell products or tell you to be in a product or not, but just answering a general kind of question of some of the research we've got from Spriggy, and more broadly around how that works and how investing for kids or saving for kids, some of the things we've heard of and thought of, and tried true tested methods, and different kind of futuristic methods as well. So just chatting on that today. So with the Spriggy app, we had a look at CanStar, which is one of the research houses, which spoke a bit about it. It's about $30 per child for use,
which is quite expensive.
You've got to have a parent. App or a wallet associated. It's a deposit taking institution, Arnie. So it's regulated by APRA, but I don't believe it's government guaranteed.
It's not government guaranteed.
No. No interest is an interesting one. So no interest paid on the savings in the account itself. So they can have the kids can have money in there. The parents can allocate money from the app. You can set up tasks or jobs with the app itself. So you can have recurring, or you can have one-off jobs where it releases pocket money to the child's app.
Savings targets and milestones.
Yep, their app. It's a Visa card, so it's got a card attached to the app. $990 limit, $99 limit. It's $1 minimum transfer, and $30 user fee. So that's probably just a bit of an overview of what the app is. Boys, jump in and talk, I guess, anything you want to add about the app, and then we can talk a bit broadly around investing or savings for kids and mechanisms around that.
Yeah. Brad, you go first, Brad, then I'll chip in.
Yeah, look, with my nieces and nephews, I kind of like to, at least look in their space, and I've set up a few little things for them over time, because I think financial education is something that is not done well in our current education system, for how important it is, when you grow up in life, become an adult. I think a few personal opinions. I think, under 10, I think utilising, I saw this kind of this point made, which kind of I do agree with, so I'll kind of repeat it, which is kind of, under 10 years old, we should, there's a real education lesson around using kind of physical cash. So children need to experience kind of earning and saving. I know we're in a digital age, but it's much easier to, physically this minus this equals this. Using physical cash kind of teaches that children that like money is limited. When it's gone, it's gone. It's not kind of in your hands. So there's kind of one side of that, but then there's also around like children visually, and the marketing side of something like Spriggy is great, because you got your tasks, you got milestones, you can kind of visually kind of see some stuff. And so from the visual side, I think it's great. I think under 10, personal opinion, just kind of, the physical side of things, and you can do something on the digital side, whether it's around kind of, some little stock account or something like that. I think the $30 fee and the no interest rate, personally, again, and again, not guaranteed deposit, is a reason why probably I'd stick, at least with my nieces and nephews, I don't have any direct kids, with kind of just their bank accounts and just a debit card kind of around that. That's just kind of my quick thing. I just dealt with, the price and the interest rate.
Yeah.
Around it, that money could go, that $30 a year could go towards something that could kind of benefit them over the course of their life. So,
and this is, I got a few extra thoughts about it. So thank you, Joel and Brad, and Em, thanks for this. Is a great question.
Yeah, great question.
So Spriggy, you guys have touched pretty heavily on the wallet side, the payment side, the aspects of the pros and cons of pocket money and physical versus digital cash. I agree with all of that. The part that really interests me about Spriggy Invest is the Spriggy Invest
tax
function. No.
No?
Yes, tax always, but Spriggy Invest. So Spriggy Invest is the thing that I see like value in this product, and it's what got me excited about researching it for Emily. But I was sort of curious as to how they were doing this, and basically what they've done is you can set up a part of the Spriggy account. I'm not sure exactly who the players are here, because just to give clarity for the tankers, when I was looking into the product disclosure statement, Spriggy itself is a partnership between Spriggy and Indue, and you might have heard of Indue before, because there's been talk in the Australian media about allowing welfare recipients to have an Indue card. This is basically the same thing, where they might load money onto an Indue Visa or MasterCard or whatever, and then give that person that, and they can spend it on certain things, but then they're restricted. So there's a whole conversation there around people's rights, what they want to spend on. I know with a child, it makes sense to restrict them, but in the wider view, is this almost like a use case for Indue and that service, which will then be used to extrapolate the benefits of it to put it into society? And will that be a good thing for society? I don't know. Also, on top of that, you've also got to, and this is all just hearsay from me, right, general in nature, you have to consider that the companies who are party to this, Spriggy and Indue, will then have a lot of data from a young age on spending habits and patterns and things like that.
Think about Dolomites on steroids.
Dolomites on steroids is a perfect way to describe it, Brad. I love that. We should, Dolomite on steroids. And so that's some issues I think about. You want to talk about the point that you raised, I think it was Joel or Brad, saying that there's no interest paid on money held in that account. I guarantee you, whoever holds that money, which is probably Indue, is earning money on that.
Oh yeah, no. I guess what we're saying is no interest paid.
It doesn't come back to the consumer.
The recipient. So I mean, that's part of where they're making their money, right? Is they're keeping the dollars.
Yeah, I think it's split, right? Like I think Spriggy probably earns the fees and the annual fee. Indue probably makes their money from a partnership and whatever is disclosed, and earning fees on anything that's held in those accounts, and then they could potentially be lending it out and funding other parts of their business. Yeah. And then you've got Spriggy Invest. So Spriggy Invest, just generally what it is setting up an account, and it's almost set up in like super. Like you can choose an option, you can choose conservative, you can choose balance, you can use high growth. You can choose Aussie stocks. You can choose global stocks, right? So for those that don't know,
Well, you don't pick the stocks. You pick
the ETF. Sorry,
the ETF. Yeah.
Yeah. So Joel and I, in the early days, did a podcast on ETFs and what they are. If you go to the Spriggy website, you can look and they give a very basic, generic description about what an ETF is and how it works. And then that got me curious as to how they've set this up, right? And is this a tax-effective structure? Because typically what it means is you're going to be putting an investment in. And if you hold an investment in Australia for over 12 months, then you get a 50% reduction in capital gains tax, assuming you've made a capital gain when you sell it. And that made me wonder how they've structured it for the parent and the child. And what they've done is they basically just said, any tax implication is on you, and it's only in the name of the adult who holds the account. So what that basically what that basically means is you're not really investing for your child through this. You're going into an expensive vehicle with extra fees, choosing.
Well, let's say the extra fees, anything is $2.
Yeah.
All right? And 0.2% of the transaction over $1,000. But I mean,
on top of the administration fees you've already covered,
the $30 on top of the $30. Yep.
Yeah,
and no interest gained on your money.
Yeah, so it's almost like, I don't want to criticize them because I actually love this idea. I love that it's breaching this.
Love the idea, but could be better set up and structured in a less. In a way, Arnie, I think important thing. Sorry to cut you off, but they just raised 35 million, right?
Yeah.
So I think the key thing here is, have they got education and your child's savings as front of mind, or have they got profitability as front of mind? Well,
they want both, right? And this is free markets at work, right? So like I'm hopeful, I'm optimistic that this product will become better refined, will offer better options for the consumer. But obviously they're trying to scale to profitability as quickly as they can. And they do have a learning section about investing. So that's a good thing. They're trying to teach people. But in general, what I'm saying is that you're limited in your options of ETFs you can choose. There's a lot of extra fees here. And then if you were to make a gain on this ETF and then sell after all the fees and costs associated, which are more than the standard broker, then that money is coming back in your name, getting put onto your taxable income, and you're paying for it. So it's not actually the kids' money and it's not in their name, so they don't get any benefit to it.
And of course, not tax advice here, so seek your own professional.
Yeah. So what I might say about just kids in general and tax rates is that if you're under 18, and aside from exceptions, so like if you have a part-time job, that's not tax, that's taxed normally. But if you're under 18, the tax brackets are $0 to $416, no tax for the year, $417 to $1,307, taxed at 66%, and then over $1,307, it's taxed at 45% of the total amount of income that's not accepted. So accepted income would be like your part-time jobs. A tax-effective way to invest for a child would be through a trust structure. That comes with its own set of like issues and administration and costly and fees and things like that. But in doing so, what you're doing is you actually are investing in the child's name. And then when they come of age, like if they sell, that taxable gain or loss will already be there, and you won't have to incur a taxable event yourself to transfer the money. So that's something I'd like to see change in the space.
Usually you'd invest in trust for your child. And obviously you've got income through the year that you've got to declare on your own tax return, but then inevitably you can transfer the investment across to the child. It's an interesting one, I guess, talking just more broadly and generally about these apps and investing apps and whatnot. That's probably the fine print you've got to be mindful of. They're sort of not praying, but they're kind of working on the fact that people can be generally lazy when it comes to finances, and setting up a pocket app or something like that and putting money into it. You know, that's where you're going to, what'd you say, Brad?
It's that whole time poor parent market.
Yeah, time poor. It's, you're putting money in and then they'll take their clip on it. And, is it sort of working out in the best outcome? Possibly not. But it's more, I think, if you think of the fundamentals and the mechanisms around, I'll look at it in two ways. If you've got savings and you've got cash flow and you've got learning how to do that as a child and adults, and then you've got investing, then you got, how to
two different sort of things, right? Yeah.
Two different things. I think learning cash flow, how to handle money, how to appreciate money, how it's earned, how it's spent. That's one side of things that I think is really important. And you touched on that, Brad, with your savings and physical money. And that takes time and effort from the parents' behalf to do that and get money out and have it there and make it regimented in your process. So if you want to do it, you can do it, but it does take effort and time to teach that. And those lessons could be extremely valuable. Taking that into a digital format, which is the way of the future for kids, and they're very good with their iPads and technical stuff, then you're getting that lesson, but you're not getting it physically through fiat currency or through money, exchanging hands, where they can actually see their savings, whether it's in glass jars or whatnot, that's what they're saving for, a toy or an experience, and that's what they're going to spend. So that's definitely, I think, still a really great methodology around learning and appreciating money, but it does take effort and time.
Just to wrap it up, right? Because I'm actually curious now. We can tack this into 50-50. Just for Emily's benefit and the tanker's benefit, I want to know: would you, Joel, or you, Brad, with your nieces and nephews, or me with my children, would you use Spriggy, or would you go with a different method? What would you do?
I'll go a different method. So I'm a benefit of having a lot of time now. So I kind of would rather go down, the path of, physical lessons, physical cash. If I'm doing investing, doing it with them through a vehicle. So that's just kind of my personal preference.
Crypto account for the kids.
Crypto account for the kids, mate.
Oh, I got to give an update on. No,
50-50. Can't. Joel's go.
Yeah, Joel first.
In terms of in that, I'd go down. I wouldn't go down the app route at this stage unless there was something that I felt better. I'd prefer to try to teach them, engage them with money and how it works, and explain them in simple to understand terms of savings. And there are cheap bank accounts out there. You can get low cost bank accounts and show how transfers works and how the balance goes. And I think one of the best lessons I learned as a kid from Dad and my uncle was, how shares work, and checking out the paper of the share price. That's sort of showing my age, is picking up and seeing the stock price of the share you own. You can actually tangibly see it and work it out and see the money there.
The same with borrow shares.
How compounding works, compounding interest, which is not really that applicable in today's age with interest rates. But there, I think more the learnings and the lessons that are more ingrained in you and more valuable in the longer term, as opposed to a shortcut, version of an app, of any app. I think if you can learn those lessons of cash flow, saving, spending, and investing at an early age through help and mentoring and physical experiences, I think you're much better off as a child growing up.
Would I use Spriggy, or would I choose a different method? I would probably shy away from Spriggy, even though I think it's a great idea, and I feel like it could, if it improves significantly in the space, and there's better
structures,
transparency as well around how they use the data, what happens with the money, and if their cost structures come down, especially if the investing part changed. I'd be in
also, the deposit insurance, the deposit insurance goes, because at the end of the day, it's a private company, it could go under.
Well, actually, I don't know if you mentioned that, Brad, or maybe you did, but the prepaid stuff is not covered by insurance for an Australian deposit taking institution. The wallet stuff probably would be. I haven't looked too closely into it, but
I read it wasn't, but I mean, I understand from your bit, Arnie, deposit taking institution might be, but anything transferred to that kid side of things.
If it's prepaid, it's probably not. If it's held by someone like Inju, there would have to be some kind of protection at some level. I don't know. But so I wouldn't use it, Em, and that's just my own. But it's a good idea. It's a good thing. I hope it evolves.
Great question. Keep the questions coming in, guys. Thanks, Em. Where can they write the questions to us, Arnie? I know email us on Facebook.
Yeah, get us at Facebook, at Money in the Tank on Facebook, Instagram, on YouTube, and on Twitter. And we're going to make an effort to be better across those. I want
Before you wrap up though, Arnie, how's Luna?
Yeah, well, we should do another 50-50 maybe if we've got one. But I put $100 into Luna.
How much is it worth now about?
It's worth 12 cents.
I did say not to.
But you know what? Like if I hadn't put $100 into Luna,
you wouldn't have learnt your lesson.
Well, I was going to say I would have bet on the D's on the weekend. And I probably wouldn't have just bet on the win. I would have bet on some crazy multi-bet. So my Luna investment's doing better than my sports betting at 12 cents. So
keep us posted, mate. Keep us up to date. And we've been with our guys for a good 55 minutes, so we won't keep you any longer. I thought the weekly ones would mean we're in and out within 20, but there we go. Here's a tip as well: if you're listening to us, listen to us on 1.25 speed, because it'll actually increase your productivity throughout the day too. So I love podcasts on a quicker speed. But anyway, everyone have a great week, and we look forward to catching up with you guys next week. Keep those questions coming in, and keep well. Cheers. Cheers, guys.